Fortunately, as this channel grows, I get more and more comments and questions from the subscribers. However, sometimes my answers can get lengthy. In those cases, I think it might be better for clarity to reply with a video. So this will not be a regular scheduled series, but only when the need arises. So let's take a look. This chart and the next chart coming up should be interesting to those of you who are invested, say, in Visa or MasterCard, Marco. And what we see here is that the delinquency rate on credit card loan balances at commercial banks, so it's the smaller banks, not the largest 100 banks. So at the nearly 5,000 smaller commercial banks in the U.S., the delinquency rates rose to 6.2% in the second quarter 2018, and that exceeds the peak during the financial crisis by a full percentage point and was up from 4.0% a year ago. But for the largest banks, which carry the majority of the credit card loan balances, the delinquency rate is only 2.4%. So let's go to the next chart. This chart here shows the credit card charge-off rates, and the charge-off rates among the largest 100 banks in the second quarter 2018 rose only a fraction year over year to 3.6%. But among the nearly 5,000 remaining smaller commercial banks, the charge-off rate spiked 3 full percentage points year over year to 7.8%. And that's the highest since the first quarter of 2010. And the rate among these smaller banks had peaked during the financial crisis in the first quarter of 2010 at 8.4%. So what's going on here? A couple of things. First is that the largest banks, they learned their lesson from the great financial crisis, and they have continued only to lend to the better credit customers. But in order to compete, the smaller banks, the 5,000 smaller banks, have had to allow customers with worse credit. Hence, you get the higher delinquency rates and the higher charge-off rates for those smaller banks. But the other lesson here is to keep in mind that the higher credit card charge-off rates and delinquency rates of those smaller banks may bleed into those top 100 banks sometime in the future. We don't know. That's just speculation, but I think it stands to reason. So let's go to our next topic. So here we're looking at Buckeye Partners LP, and the symbol is BPL. And I had a question with regard to Buckeye Partners. One of the subscribers, Snowfire, asked me to take a quick look at Buckeye Partners and give my comments. And based on the most recent quarterly reporting, Buckeye Partners, the latest results were somewhat disappointing compared to what some of its peers have produced. The company showed strong revenue growth due mostly to higher volumes as North American oil production continues to ramp up. The company results were dragged down, though, by poor performance from its global storage and terminal operations, as shown by this chart here. The market appears to believe that a distribution cut is coming. And there were certainly some positive items in the report, but there were also some negatives that should be of some concern, unfortunately, here. And the partnership reported an operating income of about $145 million during the most recent quarter, and that's rather disappointing when compared to the $170 million that the company reported in the year ago quarter. And one of the reasons for this is that the Buckeye Partners Global Marine segment delivered worse operating results. Most notably, its Caribbean Storage and Terminal Services division performed much worse than a year ago. However, I think by this chart you can see that the problem has actually persisted even longer ago than that. And we see here in this chart that we had a peak back in, say, 2014 into 2015 at this point in time. And we had a decline all the way down here, say in late 2015, early 2016, with a rebound to this point, and then pretty much a fall off from there. So let's go down into the oscillators and see if there's anything that we can find in those indications. And I think definitely we see here in the MACD, we had a pretty good cycle here beginning in 2009 up to this point here, back down here, and then up here, and that's kind of where the problem started. You perhaps would have seen this decline down to this point here, but hopefully you were continuing to pay attention because the rebound here was pretty muted. Now you wouldn't necessarily know that at this point here. You'd see that we're making a good recovery with the fast line perhaps coming through the slow line here, but at this point here, this is where you needed to focus on, and you always want to pay attention to the fundamentals as well. But let's go down here and take a look at that. You wouldn't see much from the histogram, but here's where you start to see some things. Here we have the bottom at this point here, and then we had a pretty decent recovery, a pretty decent incline in the price rate of change here. So the concept that I want to talk about here is proportionality. And what I mean by that is you have a decent recovery here in this oscillator, but you go back up here to the price chart and you did come from all the way up here, but you only came up to here. In previous times, you were able to come from all the way up here, all the way up there, and exceed a previous high. The same thing here. You came from that low and came all the way up here, so you exceeded this previous high here, but you're not doing that here. So by the time that you're getting up here, you should start to detect some issues going on. And then of course we had a little decline and then one more attempt and a fail. But once this started to sell off, you definitely knew at that point that things were wrong. So that's what happened, is the MACD continued to sell off. Here again, you had a pretty good sell-off. Let's talk about proportionality somewhat here in the stochastics. You had this bottom and you had a decent move on up above the 50 or midline up to this point in here. And again, proportionality, you're moving back up to the price chart and you're just stalling out at this point in here. Moving on down into the Williams, I think you'll see pretty much the same thing here up to here. That all looks good, but it's not showing up in your price. And so you're going to have a couple of indications, and as long as you're paying attention to the fundamentals, perhaps you would have known that there were some problems. And even if you didn't know that there were any problems at this point in here, once that MACD failed and started heading down, and that downward move started to accelerate, you knew that there were some problems. Now the question is, do you hang on at this point? I'm not going to be able to answer that for you, but what I can say is, at least by the price chart, the market is expecting that dividend cut, in my humble opinion. We're down here, and we haven't been down that low since, say, 2008 to 2009, but we are pretty far down. So do you stick it out, or what do you do? I'm sorry, I can't give you that answer. That's just going to depend upon how long you want to hold on. Buckeye Partners is a very large operation, so they do have the opportunity to improve, and I would imagine they may start selling off components to help. But I think that that dividend might be cut sometime here in the future. So for today, that's ChewDog Charts. Thank you.